Here's what we would like to talk about. The FOMC meeting decided not to taper. What we had was a complete algorithmic high-frequency model, both in the equities and the option pit. And options weren't printing right, and they were dropping the bids faster because they couldn't keep up with the algorithms. The high-frequency model were high computing cycle machines called computers, the machines that actually do these in milliseconds and run them up there. Therefore, on the option side of the market, it's almost impossible for them to be able to get that right bid and ask in there. And then they'll undershoot those, and we bought some Netflix puts again, and we were hit at 1633, well below the market, and they're printing now 1480 on the ask. But nonetheless, we're going to have to find out where these real prices end up. I'm going to show some other ones right here that had that same knee-jerk reaction. And this one here is the one that a lot of people understand, is how Apple went from 460 straight to 465, has since rolled over. That was, once again, my friends, that's a high algorithmic computing machine that does these purchases in milliseconds. You can't even keep up with it. They front run the prices, so that one's acting okay, and it's coming down right away. So once again, the FOMC meeting is not going to raise rates. They skewed the option pits totally. Okay? And what happened was, like I said, when you take a look at Priceline went from down here 976 to 988 in that high algorithm model. Here, let me update the delta lines so we can take a look at some of these knee jerks based on that. So that one was Priceline. The other one, there's several of them. Tesla Motors went exactly 164 based on that, and now is coming right back down. So basically, the high computing models that are used, referred to as machines, they buy in milliseconds. And how does that work? Well, it works real easy. They could buy $1 above the ask and create, that's how they create those prints. You can't even see them. They happen so fast. Here we have that knee jerk in Amazon. We're not long or short in our MMT platform. Shot straight from, let's just call it 305.70, right up to the high of that bar is almost 3. That's about 310 almost there. So we can clearly see what they did there in those knee-jerk reactions. There were a couple other ones that had great algorithmic high computing cycle breakouts. The MasterCard, right here, live. It was down here at 678. Soon as that announcement hit by the Fed, the computing cycles that bought this thing, so they each machine that buys the bid and ask, and so what does that mean? That means that they're buying above the ask over here where people want to own it. So what do? They print like $1 above it. That's how you get these big spikes, and it's coming back down as they will have to neutralize. But the high computing cycles that happen in these things is that if you're buying $1 above the ask and another $1 above the ask, that's how you get these three big, see, each one of these lines are 58 cents. And we can clearly see on this one where they shot that thing to 3/4 delta, 0.75 on MasterCard. Shot it straight there. It was negative 0.29 on a day. Now printing right at about the half a delta range. And where is that? Well, it's 683.83 right here in our system.
Decision in a moment. Economic growth has generally been proceeding at a moderate pace, with continued, albeit somewhat uneven, improvement in labor market conditions. Of course, to say that the job market has improved does not imply that current conditions are satisfactory. Notably, at 7.3%, the unemployment rate remains well above acceptable levels. Long-term unemployment and underemployment remain high, and we have seen ongoing declines in labor force participation, which likely reflects discouragement on the part of many potential workers, as well as longer-term influences such as the aging of the population. In the committee's assessment, the downside risks to growth have diminished on net over the past year, reflecting, among other factors, somewhat better economic and financial conditions in Europe and increased confidence on the part of households and firms in the staying power of the U.S. recovery. However, the tightening of financial conditions observed in recent months, if sustained, could slow the pace of improvement in the economy and the labor market. In addition, federal fiscal policy continues to be an important restraint on growth and a source of downside risk. Apart from some fluctuations, due primarily to changes in oil prices, inflation has continued to run below the committee's 2% longer-term objective. The committee recognized inflation persistently below its objective could pose risks to economic performance, and we will continue to monitor inflation developments closely. However, the unwinding of some transitory factors has led to moderately higher inflation recently, as expected, and with longer-term inflation.
So as we have on the live video, we have a little there of Mr. Ben Bernanke talking about, the growth being slower. Well, that means where current price equities are moving forward is that things are overvalued. They're overvalued at current price levels, is what I'm saying. Okay? And the thing about it is that the algorithms and the machines used in the NASDAQ and how NASDAQ had 3 outages, well, 2 outages, and then you had the Oprah and the options, and the options could not keep up with the high computing cycles. The computers that are used, they buy those ranges up very quickly in milliseconds. Therefore, the Oprah, the reporting authority, as to where the equity price is, as to where the options should be, is that they totally, and I'll give you an example. They marked this thing down here to 1960 based on that algorithm. That means that they've undercut it, and options had big, wide bid and ask ranges. So we're going to have to find out where the prices level off here. Okay? And it happened across the board. That's going to be one of the big downfalls about these algorithms that are used in the equity side of the market that can skew or make prices not be where the real bid and ask range would be based on how they ran those up in those high frequency algorithmic models that are used. And they buy the ask in milliseconds, and another machine could chase another one. And so that's how they capitulate those knee-jerk reactions, whether it's to the upside or downside. Another thing that we're going to talk about is he's got a whole lot to say. And we're going to find out where the actual market ends up getting back, like here on LinkedIn, they're 1265 by 13. Now, what I can do is go ahead and change this order now that they're coming back up. We own those. But the thing about it is they really skewed them. And I was a buyer out early in the day at 1220. So what I'm going to do is go ahead and just mark these at 1330 for now. Okay? Because that's our cost. And I'm going to hit replace order. And I did. And what I'm saying is before any of this happened, I was a buyer here at 1220. But they marked these way down, meaning that when they ran that thing up to $250 in milliseconds in LinkedIn, the option market could not keep up with the equity side of that high computing algorithmic buy with what? Computers do the buys. And they do it so fast that you cannot even see it, let alone keep up with it. And so they really marked it down. And the reason why I'm doing this live, it's not because I don't believe in this position. I do. The thing about it is, it's how these options are going to come back and get back to where their real true ranges would be based on where the real equity balance is going to be in the bid and ask that I'm showing right here on LinkedIn. Okay? That's what I'm showing you. MMT. Here's what I can show you right now is that this is what they did with LinkedIn in milliseconds, but look at it, it's giving it all back up down here now. Okay, but it started down here. So they're going to hit support levels and whatnot. I'm going to go ahead and I'm going to take advantage and add to these positions. The 1290 is the lowest print. They're finally coming back like I was talking about is where are they going to start leveling off at and whatnot. So just for the sake of it, that the stock still remains overbought up there. And the last few days prior to this FOMC announcement, whenever they did go up there, they roll over just like this one is. And Netflix will follow the suit. So I'm going to do this. I'm going to say that we will MMT. We got in there at 13.15 on 10 of these. So I can say that we can sell. We'll just throw it out here. It's going to have to break support. If it doesn't hit our price level and we'll be buyers at the lower end, we're just going to put them out at 13.90 for right now. Okay. And you know what? Tomorrow's tomorrow and the volatility will pass. And after that knee jerk and the algorithms that have done their little dirty deeds will be out of the way. And we're going to hit sell at 13.90 right here. And we're going to hold on to our position. Now, you can see where the knee jerk reaction was in that high frequency model live. This is live, people. This is the best thing for you to know because then you're going to know what you're up against. But you're going to have to know exactly how to read where in the option market, in the reporting of the Oprah side of it, is that it could not keep up with the high print, meaning that the high frequency, this is what it does. You can't keep up with it. Look at that. And then collapses right back here mathematically, and that's okay. Just remember that the volatility will pass. So once again, this is live right here, right now, just for you, MMT, so that you will know that on these announcements where the degree, and you know, there's a lot of people that are out here protesting this, what these machines can do because it's not fair, it's not balanced, it's not within a bid and ask range. Watch the Ghost Exchange. We'll explain it to you there. Here is another example in a NASDAQ 100 stock. Okay, it's in the NASDAQ 100 high volatility Netflix now. So you can clearly see across the board in the exchange model where those machines in high frequency buy scripts and sell scripts take place. Now look, nothing goes that fast on its own with regular people buying and selling. No. These are machines that buy these in milliseconds, and now they're going to reverse and come down. The thing that I'm going to talk about is how they took the $310 put that was at 19.10 on the high. I know. I sold them up there, and I had bids 15.20, 15.80, but they undercut it, and these premiums are cost us 16.33. A lot cheaper than what we had owned them before. And that Netflix in itself, once it balances from that high algorithmic model in here, remember, this was a machine. So as they come in line is where these puts will get their real bid and ask, where the real bid and ask ranges should be. And you're looking at, you know, we're looking but like at 15.80 like on a bid and a 16.20, 16.30 ask. That's where it should be, and then it goes higher based on what's going to end up happening here. Now, this particular name, you can clearly see how those models were working in exchange model. They still continue to try to work, but across the board, everything else is trying to adjust itself from that FOMC announcement and how it's not fair. You can't keep up with the bid and ask range like that. No, you can't. But the moral to everything here is how this programs that they have in the exchange model, you can go to the Ghost Exchange, look it up on iTunes. It's starting to spill over in the option pit. in the option market, the way that they're reported, the way the price is. But remember, the bid and the ask is based on price movement here. Well, when these things are moving $3 almost in just a couple of prints, you can see where the diamond prints are. That's where a buy was and a buy was in our system. They were buying up, and then they pushed it, and now we're going to see that where these end up getting their real good bid and ask ranges, and then why we get paid dearly. Here we have the high frequency model again. You as a human being cannot keep up with that. What does it mean? They bought here, they just kept buying way above the ask. You create a print $2 above the ask, naturally something like that's going to happen. And it's done by a machine. It's not done by, it's programmed. And the thing about it is, they capitulate them to the high off of the announcement. Look at Baidu adjusting itself. So once they get down to normal market ranges, where that volatility in the exchange model, remember the NASDAQ was closed down a couple of days. And then the options reporting authority was closed down just the other day. Because they cannot keep up. When you buy from here to here, that means that options here have to get reported, and they got to find out where the price is in the bid and ask in the equities. And when this is going on here, these get mispriced and they take premium out. You have to be a buyer at the lows. Take advantage of it, because they're all going to have reversals one way or the other, no matter what, after the event. Some of these stocks and these high betas are extremely overbought, and they will adjust themselves over time. But here's what Baidu, B-I-D-U, did in this high frequency algorithmic model based on a FOMC meeting.